In this final video on capital budgeting, we want to look at some more detail. We want to look at some statistics where we can understand a little bit more about the variables. So we're looking at a risk concept. Following that, we have a couple other special kinds of topics. We want to talk about making comparisons of unequal lives, something called capital rationing, and in the end, we'll talk a little bit about a concept called abandonment value. So let's work our way through. The first thing we can talk about is something called break-even analysis. Break-even analysis, in this case, is just we want to know the input or the break-even level of an input. For instance, what is the break-even number or break-even level for units? So how many units do we need to sell, given all of our information, how much to get net present value equal to 0? So this is actually pretty easy to do with the solver function in Excel. You just set the objective where net present value equals 0, and then you set the changing variable as the input variable in question. Now, if you have a pretty complicated process that incorporates inflation, growth, some random movement of variables, you do have to worry. Sometimes it won't work each very well, right? So we do have to watch a little bit how we apply this. But for most of our examples, it will work very well to be able to find out this break-even level. So here we have, for this HomeNet project that we've been talking about, right? What is the break-even level? Again, if you take that data and you plug it in, right, you're going to find that units, they need to sell 79,759 units per year. The wholesale price cannot be anything less than $232. The cost of goods sold cannot be any more than $138 per unit. And of course, the cost of capital that we solve for with this is around 24.1%. So we take those numbers and we say, well, look, our analysis, are these numbers possible, right? Is it possible for us to sell 79,759 units? If it's not possible, then maybe we ought to not do the project. On the other hand, every unit that we sell above this is going to provide profit to the firm. Likewise with the wholesale price. If we can sell it for more than $232, that adds value to the net present value, which adds value and wealth to the company. So we can then look at things and say, well, let's look at a variety of options, right? So this is what's referred to as sensitivity analysis. How does net present value vary by changing one of the assumptions and hold everything else the same? So what is the net present value? In the worst case, what if we could only sell 8,000 units? In the best case, what if we could sell 12,000 units? We need to know, what is the net present value given these characteristics? What about the price? What is net present value at 16 versus $25, and etc. So now we can graph this out so that we ultimately can see how sensitive net present value is to these particular variables. So in this case, you see, look, it goes from what? 29,000 to 216. That's a huge range. Price, a huge range. But we look down here, right? 111, 122. The labor cost, right? I mean, certainly it is affected, but certainly not anybody like the price is. In addition, I mean, the difference between material cost beginning worst is about 50% difference. But again, compare that to over here, which is, over 10 times difference, right? So if we have these now worst, average, and best, what we can do now is we can apply the standalone risk concept to the riskiness of these projects. So let's look at project A, right? And here's our values, 29, 122, 216, right? That's these numbers right here, right? So let's find based on, I'm sorry, what was that? That was based on units, right? What is the expected net present value and the risk of this project? Well, based on this value, the expected net present value is 141,723. Again, as you look down across this, net present value is positive the whole way across. So, the project's going to be done. But we do need to understand something about the riskiness, right? What is the risk of this project looking at this one particular variable? And again, you can see here with respect to, this is the labor cost. You can see that it is, again, the coefficient of variation is, it's about 20% higher here. It's actually far more riskier than the other ones, right? So again, what this allows us to do is to investigate the variables. How important are they, right? How hard do we have to work? I would say, again, with the coefficient of variation of 0.064, right? That's this down here, material handling. It's important, right? It's obviously a variable that we need to include, but we don't have to be exact here because the riskiness, the range of outcomes, depending on this value, is really not that much, right? So where should we be spending all of our money in trying to predict the capital budgeting of this particular project? For me, I'm looking at this, I'm saying, look, these two on the end, the price and the units, we need to be very, very close on those. We need to spend a lot of money in researching exactly how many units we think will sell and exactly what the overall price should be. Because if we're off a little bit, it could have a dramatic impact on the value to the firm. Now, in this case, none of them are negative, but that doesn't imply that we couldn't get a negative outflow with a different number. We also, right, can look and put things in by changing things simultaneously, right? This is what's called scenario analysis. So what happens if the average price is $20 and units is 10,000? What's that net present value? We know if you change the price, you probably change the units. If you drop the price, you might increase units. So again, if we drop the price by $17, even though we sell 2,000 more, our net present value goes down by about $14,000 odd dollars. If you increase it by $5, units go down 8,000, but net present value goes up almost 25,000 units. So again, we can look at sensitivity analysis looks at changing one variable. Scenario analysis looks at changing multiple variables. Maybe we want to look at, what do we need as far as price and volume combinations, right? What things will give us if 122,000 is the net present value that we're looking for? What combinations would we expect to get? So at $8 and 43,444 units, we'd have net present value of $122,994. If we change the price to $32, we're only going to sell 5,650 units, but that will still give us this 122. So again, we can look at the relationships, if you will, of the variables that are within our problem. So this risk analysis and understanding the relationships between the variables. Are they important variables? Are they super important? Or are they variables that we really don't need to know, that we don't have to be that accurate? One of the variables that I find that, again, depending on the project, obviously, but another variable that usually is not all that important in capital budgeting is the salvage value, right? If you're going to sell an asset in 10 years, right, how close to the actual salvage value do you need to be, right? Is it important in the decision? And if net present value varies by 3%, you probably don't need to really spend much time on salvage value. And that's really, I think, the point that I'm trying to get at here is we have all these variables, right? We need to know something about inflation, cost, units, demand, supply, right? We need all of this information. How are we going to spend our time researching that stuff, right? The more time we spend, the more expensive it is. So some things we probably don't need to be very accurate with. Other things, the more accurate we can be, the safer we can be as far as making decisions. So that's really the importance of this sensitivity and scenario analysis, is to really understand the importance of the variables themselves. So now let's switch gears and talk about something called capital rationing. And capital rationing is, it's really the way business works, right? So managers will typically set a capital budget, right? So management says, we're going to spend $50 million next year on projects. That is the budget, the budget. Is that a good budget or not, right? What happens if they say 50 million, but what happens if we have $70 million worth of good projects? Good projects meaning they're positive, right? It's going to increase the value of the company. Why can't we spend 70 million? That's a behavioral kind of question for the most part. Why doesn't management want to gather more money, right? Again, we'll talk about financing in later videos, but the importance here is if it increases value, then we should do it. So in theory, this capital rationing shouldn't exist. We should accept all projects that have positive net present values. And again, the reason for this really is behavioral. Is that sometimes management looks at these bigger numbers, the bigger number, right? And they say, that's too much debt. We're going to have too much debt. And I don't know that that's correct or not, but what we do know is that that will have an influence on the value of the company. So the objective of capital rationing, if we're going to use it, and all companies do one way or another, is to select the group of projects within our budget that provides the highest overall net present value or internal rate of return. Now, we're going to emphasize that we should use net present value because we want to maximize the net present value of the value of the company. But internal rate of return is often used as well. So here we have an example. We have this company. They have a fixed budget of $250,000. Their cost of capital is 10%. Their capital budget has six items. Here's the investment in each asset. Here's the internal rate of return from each asset. Here's the present value of the inflows. And now here also then is the net present value. So again, inflows, 100,000 minus 80, that's 20,000. So this is where we get net present value, It's just the inflows minus the cost. This is a deeper calculation of internal rate of return. We know how to do that. So the first thing we want to do, let's look at internal rate of return. And again, this is a worksheet that I provided, capital rationing. And what it does says, look, put in the numbers you know. Discount rate's 10%. The budget's $250, right? Now we're going to enter, I've already done this sorting, but you enter the projects, in this case A through F, their investment, their internal rate of return. And what we're going to do is we're going to sort this by internal rate of return, because those projects with the highest internal rate of return, we want to do first. Regardless of their cost, we want to get the highest rate of return. When you sort these projects, it goes B, C, E, A, F, D. So if you look at these, right, this ranks our internal rate of return. Now, D has an internal rate of return of 8%. So there's no way we're going to do that because that is less than the 10%. But now we have these projects. And if you do these projects, if you do a B, it'll cost you $70,000. If you do B and C, it'll cost $170,000. And that's what this cumulative investment is. So if they did B through F, which are all the good projects here, they'd spend $420,000 worth of good projects. However, they only have $250,000 to spend. So in this case, they're going to do projects B, C, and E. A and F are going to be left out. They're good projects. Now, for A, if we could do $20,000 worth of A, do it in pieces, then we could get to $250,000, right? But as it is there, we're up to this $230,000 is what we will spend next year for this particular company. If you do the net present value approach, you do the same process, put in the projects, the investment, and the net present value. And again, sort on net present value from highest to lowest. Again, you see D is out because it's negative. But now we have a different ranking, C, B, A, E, F, where the last ranking, B, C, E, A, F. So we've switched a couple of projects here. And as you see the cumulative investment, it says you're going to do C, B, and A. That gives you $250,000 investment. That is our project or capital budget for next year. We have left out, it turns out here, roughly $35,500 of value. Doesn't sound like a lot. Change it to millions, right? We're leaving out $35 million of revenue, of value that could be attributed to the company. So capital rationing in itself is an issue because it's possible that we could leave out, what's the phrase? We could leave money on the table, right? There's money to be earned and we don't want to earn it. Now, the other problem with capital rationing is what happens if we want to spend more money than we have good projects, right? What happens in this case? What if I told you that we could spend $500,000? Well, this company would say, hey, look, I've got these projects. That's all less than $500,000. Let's do all projects. The problem is this project is a bad project. So again, capital rationing can cause us to leave money on the table. It can also sometimes cause us to do things that might not be good for the overall wealth of the company. Now, how this can ultimately be used in understanding the process here is by creating something called an investment opportunity schedule. That's this. Here is the list, right? This under internal rate of return. Here's internal rate of return. And here are the projects listed. Here's the budget constraint. Here's our cost of capital. So it says, look, anything that has an internal return greater than the cost of capital is good. So we should do all of these, spend whatever this, 420,000 or so. But because of the budget constraint, we're going to cut this off. We're leaving stuff on the table. So let's move on to another topic. What do we do if we have two projects that are mutually exclusive, but there are some characteristics that provide different lifespans? So, our first alternative, let's say it's a cheaper device, has higher maintenance cost, and has a shorter period of life. The second device costs more, maintenance costs are lower, but it has a longer lifespan. So what do we do with those two projects? They're mutually exclusive. The challenge is, if you think about net present value is a sum, right? It's a sum of the present value of the future cash flows. So if you have, I'm going to use a different example to make this maybe a little bit more understandable. Let's say we have a project A that has 3 years life, but project B, because it's a higher quality project, it costs more, but let's say it's going to last 7 years, right? So A only lasts 3 years, but B lasts 7 years. How do you compare those? Well, with not even looking at numbers, because B has 7 things to add and A only has 3 things to add, B has an advantage because it's a summing process. So in this case, if we look at these two projects, A has a net present value of $15,009, B is $18,000. Looks like B is the better project. But let's say we have a discount rate of 7%. That's the 7% for this net present value. Let's look at how can we analyze these in a way that's more fair, if you will. And that's what we're talking about, the investments with unequal lives. How do you do that? There are two techniques. The replacement chain says we're going to repeat these projects until they begin and end at the same time. So for this example, we have two projects, one for 3 years and one for 4 years. If you did project A for 12 years, do it 4 times. And if you do project B 3 times, they would both start today and end 12 years. But now we have 3 net present values to look at because you're repeating this project over and over again. Another way to do this is something called the equivalent annual cost method. So now what we're going to do is we're going to take the net present value and we're going to convert that into an annuity that's received each year. So it's not, both of these have issues, right? But both of these are methods to help us equalize the time frames of these particular projects. So here we have the two projects, A and B. You see the annualized net present value for A is 6,000, for B it's 5,000, 5,300. So even though B has a higher net present value, when you spread that net present value over the 4 years of life and 3 years life for asset A, turns out that there's more value per year, in quotes, more value per year for A than B. For the replacement chain, again, this is a little strange. It's not perfect, but basically this says, look, to find the replacement chain, you just take this number times this number, and that gives you 12. There's other techniques you could do that would make the terms use the least common denominator, but this does it right every single time, and you get the same answer. 48,000 for A, 42,000 for B. So it turns out for both of these techniques, A, even though it has lower net present value, because of the difference in time, it's going to provide more value to the company. Now, the last technique that we want to talk about is something called abandonment analysis. And this is something I think we would do with every single project that we want to think about. So what this looks at is differences in lifespan. So let's just use this most recent example, right? Project A, you spend $12,000. What if you only did this project for 1 year, and at the end of the year, you sold the project and canceled it out? What would the net present value of that be? Now, the only other number we need to know is what is the salvage value at the end of each year. So the first abandonment value, say 12,000 plus 1,500 plus, again, this would be whatever the abandonment is. What's that net present value? 12,000 plus 1,500 plus, again, now this is 1,500 plus whatever the abandonment value is at the end of 2. So we're going to have a string of net present values. Now, what this will help us do is find what we refer to as the engineering lifespan. This is the optimal life of the project. You should not do the project longer than the engineering lifespan because values will decrease, they'll decline. Net present values will decline. So we have this project. This is project A from our beginning projects we talked about. And here we've estimated some salvage values each year. Now we're assuming that this last year, the salvage value this last year is actually incorporated in this cash flow. So that's just a little quirk of this technique. But now we just want to look at net present values. If you do this project for 1 year, you spend $100,000. At the end of the year, you earned $50,000, and you sold the asset for $85,000. So the cash flow for year 1 is $135,000. That net present value would be 17.3, or 17,000. If you did 2 years, I'm just going to do 2 years here. You spent $100,000. You got a $50,000 year 1. In year 2, you gathered a total of $115,000. $50,000 from business, $65,000 from the conclusion of the project. Now, net present value went up to $30,000. Year 3, it's $37,000. $41,000 for year 4, and year 5 is this $34,000. So what this tells us is the engineering life of this asset is $41,819. Now, if you look at the internal rate of return, after a while, these numbers are going to be pretty close throughout most of this. Modified internal rate of return, again, we can rank them however we want, but this looks at our 4 primary techniques that tell us which one is the best one to do. Now, the modified internal rate of return says you should only do this for 1 year. Likewise, the internal rate of return says you should only do this for 2 years. But we know that 41,000 is the most that you're going to earn. And net present value and the profitability index, in this case at least, agree with each other. That this, again, if we do this for every project, now we have an understanding of the best value we can get from each project. Now we include these numbers in our capital budgeting analysis. Which project should we do? Listed by this value, not in case let's just do it for everything for 5 years. So that's the end of this process, if you will, of analyzing the capital budgeting and decision-making process of the company.